Hello, welcome to our class on how to lock in a 2.25% interest rate on your next loan, your next mortgage, using assumable loans. I'm going to pull in my friend and business partner, Andrea Ransom. She's on the loan side, and we're going to have a conversation about this. We're going to share the benefits, the risks, the strategies, the myths, everything that you need to know. Well, this is going to be a high-level view. If you want more specific details to your situation, because everybody's situation is going to be different, then we can have a private conversation later. But this is everything you need to know to get started. So let me bring Andrea in here now. Let's see. Oh, Cora asked to come in. Can you say hello in the comments? I might be getting you in. I don't know if I'm going to have enough bandwidth because these Facebook Live with other people take a lot of bandwidth. Hi, Andrea.
Hi, how are you?
Good. How are you? Thank you so much for joining me and doing
Good.
this training with me.
Yes, of course.
So okay, we might have a little bit of a lag, but just bear with us because this is really important information, especially right now where interest rates are typically a lot higher. This is a cool little hack that you can do to help you out. So I'm on the real estate sales side where I specialize in like sustainable living, outdoor living, and horse properties, and also neighborhood properties that have really cool access to outdoor activities. And this is Andrea. She is a rock star loan officer who deals with all kinds of situations, entrepreneurs, just unique situations. Everybody's got a different scenario financing wise, and she's really good at all these unique things. So super glad to have you here with me, Andrea.
Thanks, Sarah. Thank you.
So, and you guys, feel free to put your questions in the comments. We may not get to it immediately, but we'll look through the comments and be able to answer them either on the video or we'll answer them in the chat later. And definitely reach out to us if you have any specific questions that you want to get more of an in-depth answer on. So we're breaking this down by strategy and benefits, risks, and myths. So we're going to cover all those things because it sounds really awesome, right? You can lock in a 2.25% interest rate, which is hundreds of dollars of savings on your payment every month, potentially. But there are some things you need to know about it before you get into that. So, so Andrea, let's see, do you want to start off with some of the benefits on that you know on your side with the financing?
Sure.
Either selling, if you're a seller, offering an assumable loan, or if you're a buyer who is assuming the loan.
Yeah, of course. So, VA, the only two types of loans that are assumable are going to be VA loans or FHA loans. So conventional loans would never be assumable. So we're always looking for who is a past veteran that bought a house, when rates were low, or refinanced when rates were low, who could now offer an assumable mortgage going forward. So the biggest benefit, of course, is that you can get an interest rate that just doesn't exist anymore. So for those couple of years, our mortgage rates were so low, it felt like there was a sale on interest rates. And so now this is a way to take advantage of that. So there are some caveats that we're going to talk about that, make it a little bit, just of a unique situation of when it works out and when it doesn't work out. But of course, the biggest thing is that your loan, that you can assume that loan. And when you assume that loan, you're assuming it at the current loan balance. So if somebody borrowed, we'll just use really simple numbers. If someone borrowed $500,000 and they've paid down, $20,000 of that, then there's a loan left over right now of 480. So you could use that 480,000 as your balance of your loan. And then if you needed to make up the difference on what you needed to make up the difference on the purchase price, you could get a second mortgage behind that. So basically the biggest thing is offering or getting that lower payment on your first mortgage with a low interest rate. And then on the seller side, I think it's just attractability of, offering your house and your loan to a potential buyer at that lower interest rate.
Yeah, that's especially right now, the market's pretty strong right now. People are selling pretty, like in general, pretty easily and quickly, and a lot of people are getting sales above asking price. But at the same time, I'm seeing a lot of price reductions. I mean, percentage-wise, most people that are listing their house are having to reduce the price on the house at some point before the sale, and people are still getting a lot of concessions at closing. So it's definitely not as hot of a market as it was. So this is just one of those things where it's an added incentive if you're selling your house to be able to offer some creative financing, because I mean, in Andrea, you did the breakdown, right, for a house this is a real house. It's on the market now. That's about $1 million price point, and they're offering an assumable 2.25% interest loan. That's major savings on your payment every month. And so that potentially, this house, for the right people, that could make it sell really fast and even create a bidding war if people are educated on the process. Mm-hmm. So that can be a major benefit to the seller. One thing that is a benefit, and maybe you can speak on this a little bit too, Andrea, is whoever originated that loan, whoever bought the house to begin with, they paid a good bulk of the interest because you pay more interest up front. And especially if it's a VA loan and they didn't have much of a down payment, because you don't need a down payment for a VA loan typically. They already took care of a lot of that legwork for you on the interest. And so if you're going to take that over, then depending on when they got it, you are putting more towards the principal. So you're going to pay down the loan faster than if you were the one who bought the house. Do you have anything to add on that piece?
No, I don't. And so I should be explain to people also how the loan process works with VA assumption. So when you do a VA assumption, you don't work with somebody like me. So I work as a loan officer for a mortgage broker. Mm-hmm. And, typically people would come to me, get pre-approved, we'd place their loan with the lender, you'd close. And when you do a VA loan assumability, the process is very different. So you actually go to the servicer of the loan, the seller will need to request that the loan be assumed, and that's the process that they're going through. And then you would work directly with that lender. So there are some gaps in my knowledge because of that, because the process is totally done by the servicing lender and not with a loan officer. You don't really have like a go-to person like me in this situation. So some of the answers I don't know. So yes, I'm with the VA loan assumability, somebody, there's more interest paid up front. If somebody's loan term was 30 years and they assume the loan and they've been paying on it for 2 years, then your term is 28 years that's left, So that would make sense that would be how it would be structured.
Okay. And that brings me to, let me just make sure I don't have any other benefits I wanted to share. That was pretty much it on the benefits side. And, depending on the person, there may be other specific benefits to your situation. But as far as the strategy goes, one thing to consider with an assumable loan is that you might have more down payment to bring to the table, because you're going to have to pay the difference between what that loan amount is and the sale price. And this is where Andrea would potentially come in this scenario, is getting taking out a loan on a portion of that down payment, because if there's a difference of 100 or 150,000, you may not have been prepared or planning to make that much of a down payment. So, so Andrea, can you share what types of loan options people have for the down payment, the cash to closing?
Yeah. So you're going to have two options to do a second mortgage to make up the difference between the purchase price and the current loan amount. So you're going to either have an option to do a HELOC, which is, or HELOC or HELoan. So a HELOC is a home equity line of credit. It works very much the same as like a credit card in some ways, in that you can borrow, $100,000, and as you pay it down, you can borrow more, and pay it down, borrow more. So this, you can do a HELOC for purchase money second, or you can do a HELoan. And a HELoan is a fixed rate mortgage, and the second mortgage sits behind the first mortgage, and that's fixed, meaning that you borrow 100,000, you pay it down over time, and that you can't just continue to reborrow off of that. So that's why it's called a HELoan and not a lock, like a revolving line of credit. So those would be the two options. The majority of loan programs that we have available usually go to what's called a 90% CLTV, mean combined loan to value. So when you have two loans, you don't just have a loan to value, an LTV, you have a CLTV. You combine those two loan to values, so you have a combined loan to value of 90%. So if, a home price, you need 10% down, so you would minus out what that VA loan assumability is, and you could do a HELOC or a HELoan for that remaining balance up to 90% CLTV.
Okay, so we had talked previously about a specific scenario, because there's multiple homes on the market that are offering this, but there's one in particular that I like because I'm friends with the seller of it, and so I want to help her out a little bit, and B, I think it's a cool example where this is a higher priced home, and when you're talking percentages, you're talking like exponential potential, savings.
Yeah.
And so I thought this was a good example just to illustrate how much you can be saving on a monthly basis. This one is about $1 million sale point. And what are the interest rates, right? Just on average, the average typical interest rate right now?
Well, I looked at VA rates when I compared, but so on a conventional, you're probably in the mid to high sixes right now, 6.75 or so, with money down, not 100% financing. And then on a VA loan, you'd be at low sixes likely.
Okay.
So VA rates are typically lower in general because they are backed by the VA, and you pay a funding fee on those, so they are a little bit lower in general.
Okay,
so when I ran the numbers, like, and I can continue to crunch some numbers here too as we're talking, but when I ran the numbers, I looked at if we were comparing a 10% down jumbo loan today, like because the purchase price of the property that you're speaking of was $998, correct?
Mm-hmm.
It was like 98, and so I looked at that at 10% down, and at 6% interest, which would be a good interest rate. And that payment is at just principal and interest, not talking taxes and insurance and HOA or anything else, just straight principal and interest. That payment came in at $5,460.56. And that's on a loan amount of $898,200. And then when we compare that to the assumable loan, I'm assuming that person, based on the numbers we talked about, has about maybe 560,000 left on their first mortgage that could be assumed at 2.25. So that payment is $2,170.55. So the biggest variable with the first and second combo is what interest rate can you get on that second mortgage. So that would be, I put a rate of 10% on the second mortgage, and that payment could be at $2,973.48. So in this scenario, the combined if you're putting 10% down in this scenario, you might be saving, $300 a month or greater if we could get a lower interest rate on that second mortgage. And so there are some HELOC programs that have like a first year introductory rate that could be lower. But so it maybe would save you at 3%. So when I looked at the numbers, I think in this scenario with this larger loan amount and the spread between the purchase price and the original mortgage, this scenario would work really well for somebody who maybe is selling one house and moving into another house and has some equity to transfer over, so that they're actually borrowing a lot of that, the whole 560 on that assumable loan, and then maybe only need to take out a HELOC for another 100 or 150 or 200, not that full 10% down. So in each scenario, it's going to vary so greatly based on, what down payment the new buyer has, what the original loan amount is, and what that spread is. The larger the spread is on from the assumable loan to the purchase price, and how much you need to make up with that second is going to impact whether or not the assumable loan makes sense for people. So because the second mortgage is a higher interest rate, it does there is a point where it tips the scale of like, does it make sense to do it that way, right?
Right.
So those numbers have to be reviewed and analyzed to say, what makes more sense, going with current interest rates in one loan or doing the assumable loan with a new second behind it based on what your down payment is. So not as clear cut. It just really depends on, like, everybody's going to have a different situation of what they can come to closing with. So.
Right. Yeah. I mean, on that idea that everybody's got a different situation, I mean, somebody might need that bigger second loan because they don't have much of a down payment now, but they may be able to pay it off quickly.
Right.
Like, say they're going to keep their old house and rent it out, and they could maybe even take a HELOC on that. I mean, there's like unlimited situations, but say they're planning on a gift, but then this opportunity came up now and they don't have time to receive that gift, or they just have money coming from somewhere. They could take out the loan, the HELOC or the HE loan, and then pay it off, quicker.
Yeah, if you had an opportunity to say, I know, and over the next, 3 to 5 years, I'm going to be receiving this additional income, I could pay down that HELOC or HE loan faster. So I want to keep that second or that first mortgage with that lower rate, then yeah, totally makes sense. So, I mean, all of those factors, and that's why Sarah and I both know, like, no one person in property is the same. Like, every single person has, a different set of what's happening in their life financially and everything else, that it's really, a case by case basis of, is this the right step? Is this the right, action to move forward on?
Right. Right. I would say for this one, the best case scenario would be if you have a significant amount of equity, or, 500,000 in equity, and you could sell your house and move to this one. I mean, this is an issue that I've been seeing with a lot of people where they want to sell, but they're not really moving up house-wise because everything got so expensive that even though they can get a lot for their house, they're still going to have to pay a lot for their next house. So this is a way where you could do that and at least lower your payment. So
I agree. I think that would be, to me, that would be the most ideal scenario. Like, we know many people right now who want to move up, and they have equity in their current property. But the thought of moving up, because, moving up means a higher interest rate typically, because they refinance during the lower rate period. So, like, yeah, if you had, if you sold a house and you're walking away with, $200,000-$300,000, and then you transfer that money to this, I mean, this would be a beautiful scenario for that. This would be, and no brainer, right? It's just like totally would work out. So
right, exactly. Okay, so
I did see a couple questions in the chat earlier too. So one was, do you have to be a veteran to do a VA loan assumability? And from everything that we know and seen, is the answer is no, that you don't have to be a veteran to assume a past VA loan. However, the seller has repercussions because of that. So the seller may or may not agree to those terms because they potentially could lose out on future eligibility to get another VA loan themselves. So if they don't need a VA loan for the future, they may be okay with that. If they do, then there's some things there. So, but yeah, the answer is yes, you are eligible as a non-veteran to get that. And then the other question I think I saw was, how does the approval process work? Is it the same approval process? And yes, absolutely. When you call the servicing lender to initiate a loan, a VA loan assumability, and you maybe was going to get to this and some of you had to set steps, but on that one, it's just like you do have to qualify, income, asset verification, all those things, credit, all those things are still going to have to happen to be able to assume a loan that's a VA loan.
Yeah, and what I was reading is that the process is a little bit different. I mean, it's the same steps, but from what I have read, and it could be different, in different areas, is that they won't engage with you. The VA lending company won't engage with you until you're under contract, which means you have to you would have to prove that you're eligible, that you're qualified in order to go under contract, because they don't want to go under contract without that pre-approval and then go through the process and find out, wait a second, you don't have the right credit scores and debt to income ratio and stuff. So that was a recommendation to make sure, if you're going to do this, that you would be eligible. Like if you're already pre-approved, I mean, that's like a no-brainer. It's like, I'm already pre-approved for a loan. And you can show that to the seller and show that pre-approval and say, I'm not pre-approved specifically for this assumption, but this does prove that I'm eligible. If you don't have that, then you'll still want to make sure that you have, some people are saying like a 620 credit score. I've heard that it can be less, but if you want to be safe, if I was a seller, I would want to see at least a 620 credit score. And the debt to income ratio, what would you recommend somebody has for a debt to income ratio?
I mean, I saw, when I was looking at some guidelines and stuff online today, it said 41 as a debt ratio, which is really low actually. So, but yeah, 43 is typical for conventional, and then VA loans typically can go up quite a bit higher from there. So 45 is probably what I suggest.
Yeah.
So as a debt ratio on your gross income.
Okay, yeah. So overall, you want to have a pretty strong financial credit and borrowing situation in order to make an offer like this to somebody. Let's see. So some risks that come with this is that, like what I just mentioned, you are not going to be approved until you're already under contract. So you want to go into it with the idea that this may or may not work out. It probably will work out as long as you know you're a strong borrower, but there's a chance that, it is kind of a risk for everybody. So especially on the selling side, go ahead.
Right. It's a longer process. So like, a typical transaction, 30 days or less. And with the assumable loans, it's 60 to 90 days. And so it is a higher risk to the seller that they have their house off the market for that length of time. It's a longer transaction period for you, the buyer. So that is definitely one of the more riskier parts of it.
Yeah. Yep. And so another is that, let's see. Oh, we touched on this a bit, but if you are a seller and you accept a buyer who is not eligible for VA loan, then you can eliminate your ability to take on another VA loan in the future until that loan has been paid off. So, just to know, like, if you don't really care about that, I know some people don't even like VA loans. They're eligible, but they'd rather just get a conventional loan. Then that's
the reason for that is the funding fee.
Yeah.
So,
Oh, I can't hear you. Can you hear me? Hold on.
Hear me.
I couldn't hear. Now I can hear you.
Okay, okay. But the reason some people don't like VA loans is that there's a funding fee on a VA loan, and the funding fee, can be, 1.5% or 2% or whatever. There's different levels based on first use, subsequent use, all these different things. So people don't always use those if they have a down payment because they don't want to pay the funding fee. So if you have a 20% down, veteran, they're not going to typically go into, a loan that's a VA loan because they don't want to pay the funding fee on it. So they're not having to, avoid mortgage insurance with the VA loan and all that. So a seller might not need to use their VA eligibility in the future if they're getting a large amount of equity out and have the down payment for their next house. And, so they might be okay with that.
Right. Yeah, that's a really good point about reasons that people may not care about the VA. Let's see. Okay, and then the last risk that I came up with was just that potentially significant cost up front if you're assuming the loan, because if their house has gained a lot of equity, like with this one where they may only have 500,000 to pay off, that's like a 500,000 difference. So most people aren't going to have that up front unless they're selling or they've got a lot of savings or who knows what. So just keep that in mind. If you're somebody who is not in that scenario where you're able to come up with that amount or even close, and you don't want to take on a second larger loan, then just know, this may not be the path for you. But okay, so one more thing on that is sometimes it's worth it to the seller to actually finance that down payment, because they can finance that for, say, 5%, and that will be less than a typical loan for the buyer, but then more, that'll be some like passive income for the seller if they don't need that cash up front. Right. So that is something that can be worked out potentially.
I always love when there's an opportunity for seller financing, and that again is unique and doesn't always happen because people might need that cash out. But when it does, that's another great way to, leverage the situation for buyers. So
right. Yeah.
And if you're a seller and you can do seller financing, it's a great way to make interest off of your money. So
yeah, exactly. Now, as we get into these variations, the chance of falling into a scenario with this gets lower and lower. Like the chance of finding an assumable loan that has all the things lining up and including seller financing. I mean, that's kind of like the stars align kind of scenario. And then it becomes a numbers game where it's like, if I have, say you really wanted this assumable loan, it was part of your financial plan, and that's a major motivating factor for your move is this longer term financial plan. And so you're specifically looking for assumable loans. You're going to want to isolate the assumable loan with your search. Just in the past week, I've come across 2 of them, which is actually a lot because I hadn't been seeing them previously. And these are just random, I wasn't specifically looking for, I randomly came across. So that's a pretty good sign that these are easier to come by now. But there are ways where you can specifically seek out assumable loans so that you can increase your odds of finding all the scenarios that you need. And that would be things like leveraging the Facebook group, the Real Estate Secrets to Win, because there are people in there who are usually more open to creative situations, creative financing. And also talking to me, I'm incredible. I have a ton of connections with people who are looking to sell in the next couple of years. And if the right scenario comes by, you just never know how motivated or ready somebody might become. Like if they have a qualified buyer who's right there, and they want to do this assumable loan thing, that all could work out. So just let me know, because I can tap into my network, and I hear about this kind of stuff all the time. Whereas if I come to somebody and say, hey, there's a buyer here, and they're qualified and they're looking to do this thing, suddenly it's like, well, maybe we could act a little bit faster if we can bypass a lot of these other steps. So let's see, Andrea, do you have any other thoughts on that for if somebody's looking to do something like this?
Yeah, I would just say that I think we're going to see it more and more because we weren't seeing it previously because everyone could just get a new loan at a low interest rate a couple of years ago, right? So nobody was offering it, nobody was thinking about it. It wasn't even like, oh, everybody, you just buy a new house and you get 2.5 or 3% or whatever. So now that those rates are not available anymore, and we have a few years, we're getting to where we're over a year of our higher interest rate environment. And so now people have life changes happening.
Mm-hmm.
They're they're growing, their family's expanding, they're downsizing, they're getting a divorce, they're getting married, there's all these scenarios, and people were in these lower rate loans. And so we'll see transitions start to happen. So many people refinanced or bought during that low interest rate period that as people transition, I think it'll just become more and more common that people at least offer this up as an opportunity for their new buyer.
Yeah, I agree. I mean, a lot of people don't necessarily realize that this is an option for them. And so if that's all the more reason to like specifically ask. So if you're looking to buy a home now and you don't see any assumable loans on the market for what you're looking for, then I mean, you can literally just go to the seller or the listing agent and say, hey, would they be open to an assumable loan? And I can help you look up like when did they buy their house. If they only bought their house in the past 2 or 3 years, or even if they bought their house 10 years ago, there's a good chance they refinanced. I mean, we refinanced 2 or 3 times because the interest rates kept falling and falling, and we're like, oh my gosh, we need to take advantage of this. So we're one of those people where we didn't buy into the lower interest rates, but we refinanced into it. So you just never know who would be open to it.
And people
What was that?
took a lot of cash out during that low interest rate time. It was a great time to cash out on your
Yeah.
property. So, they might
exactly.
a higher loan amount than their original purchase price.
Mm-hmm. Right, exactly. So, so I would say if you're looking to buy a house right now and you want to explore this, then there's no hurt in asking, and there's no hurt in just exploring those options and having conversations with sellers and their agents about that. Let's see, Hazel said
About the
yeah.
So I don't 100% know about the fees because it might depend lender by lender, but from what I have seen, and again, I'm not allowed to work on the assumable loan side, so don't know 100%, but from what I have seen, is that there is a VA funding fee again when you assume that loan. And so VA funding fees vary based on the down payment percentage, whether it's been used before, you as the borrower have used it before or not used it before, but they can range anywhere like, from the lowest, I'm looking at my sheet over here, is 1.25% up to 3%. But I mean, so that would be anywhere there. And it doesn't seem that typically with a VA loan, the funding fee is just financed into the loan. It seems like on the assumable loan that is paid directly to the VA. There's not like an opportunity to roll that into the loan cost. But again, because I'm able to complete those transactions, I'm not 100% sure on that. So you'd have to talk to the loan servicer to finalize that. Did you have any insight on that, Sarah? On the fees?
Well, my understanding was there were not the fees for that, but I could be wrong. So that's a good question that we can do a little bit of research on, and maybe it depends on the scenario. So I can find that out.
Yeah, I was just thinking, I had some guidelines pulled up. I was trying to see, and it does say, it says the purchaser pays the funding fee. So This is what some of the guidelines say that I have pulled up, but again, you know, this is something that like I only have like a limited knowledge in it, in that I can't process those loans and make them go through. So somebody who is on the servicing side of the lender would have that as 100% answer for you.
Right.
But we can double check too.
Okay. One more risk or just thing to consider, and Andrea, maybe you can speak a little more to this as well, is due on sale clauses. Because sometimes if somebody assumes the loan, sometimes the bank, like the person signed into a contract that says or what do you have to say about the due on sale clauses, or do you have anything to say about that?
Yeah, so if the loan is assumable and somebody goes through the process of it being assumed and follows all the standard things, then it could not enact the due on sale
Okay.
clause. So the due on sale clause is there. Sometimes that can be called if somebody transfers the property to an LLC, if you bought it and as a primary, but it was used as an investment property right away, things like that. But if somebody were to go through the process of getting an assumable loan, getting approved, finalizing the loan, signing the documents, it can't trigger the due on sale clause for that.
Okay.
Yeah.
Okay. I heard somebody was concerned about that, and I wanted to check with you to make sure that wasn't an issue.
No, because if somebody's doing it all the right way and doing that process, then it couldn't make the loan be called back for funding. So more I've heard about the due on sale clause mostly for titles changes and switches and occupancy status issues. So
Okay, cool. Well, I think we're about at our time here. Thank you all for joining us today. And if you have any other questions, feel free to post those questions in the comments and set up a time with us to have a private chat to discuss your specific situation. Because like we've said, I mean, it's going to be so different for everybody. Some of you might be an amazing fit for the loan assumption. Some of you, it may not make sense, but you don't usually know that until we look at all the scenarios. So whether you are selling and you have a VA or FHA loan and you would like to offer that as a perk to the buyer, or if you're a buyer and you want to explore the idea of acquiring an assuming a loan, then let's just talk about it deeper and go into your specific situation and plans and things like that, and we can help you to make that determination.
I would just say too, like, not only is it case by case by person, it's going to be case by case by property.
Mm-hmm.
So,
Yeah.
if one property, has their loan amount is really high and close to the purchase price, and you're like, oh yeah, I can, make the gap work, right? So it's going to be unique to each person, and then also unique to each property, whether or not the loan can come together in the right pieces and the numbers all work.
Exactly. That's a really good point. All right. Well, thank you so much, Andrea. It was a pleasure doing this with you, and thank you all for joining us live. And this will be a recording. I'm going to put it on my YouTube channel, and also I'll be able to send it out. If you have any friends or family members who need this information, let me know when I can send them the link to this. And just let us know if you need anything else. Have a wonderful rest of your Saturday.
Awesome. Bye. Thank you.